I'll definitely say I think the cap rate reversion is probably the biggest red flag there is because it also has the most impact. When you change that, if you go from 5.5 to 5.4, magically you went from a 16 to an 18% return. So it's probably the variable. And that's where a lot of people, they feel like underwriting is too complicated and they trust the operator. They don't need to take that one step, taking like some basic underwriting courses. And there's a really good syndicate. I always recommend some of my investors to sign up for the syndicated deal analysis. They usually it's $150. He's got Michael Blanc has like a really great workshop on it. But being able to plug in the operator's assumptions and seeing and then playing around, there's really five major variables that have such a major impact on IRR and returns. So Joseph, that's a great point, is the cap rates. Ask them, what are you projecting? And in that case, in the previous deal with that Class A operator, like I guarantee that cap rate, he was actually underwriting a cap rate, a compression and not an increase, which you're technically supposed to do. It really depends on the asset class and the market. Maybe you could do it, keep it as a stable, but in reality, you're supposed to be gradually increasing the cap rate, assuming things are going to get slightly worse every year for your whole period. But when you don't see that, those are some clear red flags. And great points, Joseph. I definitely want to have a follow-up call because I could think of maybe 10 more red flags that I think would help. And I like that we hit the major ones. Let me see some of the questions. I think we covered this, but I'll restate this question. This is from Preston. What specifically is the danger with a syndicators team that's too big, that their large overhead will be unsustainable in a downturn? And if you want to chime in, and then I guess I'll chime in on this specifically.
Yeah, it's just that when you have a very big team, you have a lot of mouths to feed. And that means that you are incentivized to do deals because operators, they get paid when they also acquire deals. There's an acquisition fee, there's a loan guarantee fee. There might be other fees that they can throw on top. And those fees could be pretty big number. A couple percent of a $50 million deal is $1 million of acquisition fee. That feeds a lot of people. And so when you have a big team, you are going to be under pressure to take down more deals. And sometimes a deal's just not there. Real estate is very slow moving. And so it takes time for things. The stock market moves like a speedboat. Real estate moves like a cruise liner. And so it takes time for things to play out. And when you have a lot of mouths to feed and you have to keep doing deals, sometimes you are going to inevitably maybe buy a deal too aggressively. And I'll just illustrate this what Dennis said earlier about the reversion cap rate. So remember earlier, I was talking about how we arrived at $22 million to pay for this one asset. And then the other guy was able to go to 26.5. It was because of the reversion cap rate. We were in the, let's say 5.25 reversion cap rate. They were down at 3.9. All right. So that's just so you know. And then this was the shop that has a big team and they have to take down deals. Hopefully that answers part of the question.
Yeah, I'll throw in two things to that. First off, when you have smaller teams, there's going to be more equity percentage of employees that are equity owners of these deals. So there's a more aligned interest. Just think of it this way. If you have a team of 7, 8, and 4 or 5 of them are equity owners, that's a lot of people with a lot of skin in the game. Versus if you have a team of 20, 30, 40, 50 people, and you only have 2 or 3 equity ownership, the percentage of people who will care as much is going to be less because you're always going to care more when it's your own shop and everything like that. So I would say that's the first thing. The second thing is, as an investor, yes, you're not investing in the operator's business. You're investing in the entity that owns one piece of property. So as that investor, what you want your operator to do is make a business decision, what's in the best interest of that business LLC that you're particularly investing in. You don't want them to make a decision based on the best interest of the overall company because they might not be mutual. They might actually conflict with each other on a specific deal. So if you need to exit it, if you need to sell, not because it's a great time to sell, but you need to sell because you need your 30% of the profits to pay for the rest of the team, that isn't always in the best interest of the investor. So those are a couple of things that a big team might mean that I guess the overhead expenses are being subsidized by your investment. And that's not what you want. That's not usually what you want as the investor in a specific deal.